My name is Heather Fay, and I am the Regional Program Director for the Roanoke Regional Small Business Development Center, as well as the Botetourt Advisors. It is my pleasure to welcome you this morning to our workshop. Have you claimed your employee retention credits? Next slide, please, Tom. And if you have not filled out the poll, for those of you that are joining us as we go, if you will join that, I will leave that up as we go through our housekeeping and some opening remarks. If you would please keep your microphone muted. We are recording this session today, and you all will receive that after our program. We will be taking questions at the end, but you're welcome to add those to the chat, and I will do my best to address them, or we will address them at the end of Tom's presentation. And just a little bit about the SBDC. We are a collaborative partner of the U.S. Small Business Administration. We are funded through them, along with partnerships with Mason Enterprise Center, Go Virginia, the Virginia SBDC, and our local host, the Roanoke Regional Chamber of Commerce. We are located on the first floor of their building and are seeing businesses one-on-one through confidential advising, as well as workshops like our program today. Right, I'm ready for the next slide, Tom. We have several different upcoming events. We have one next week that I realized I forgot to put it on the slide, but we have one next week with a minority enterprise development program. Next week is Minority Enterprise Development Week, and this week is actually National Small Business Week. So thank you all for being the heartbeat of our communities here throughout our local region and the state beyond. We also have a Smart Start program for businesses that are wanting to get started, as well as a program on October 6th in collaboration with the Virginia Department of Small Business and Supplier Diversity. So we're excited to be able to offer those as well. Oh, there's the other slide. I apologize for that. So yes, that is next Tuesday at 7, and we're excited to be able to celebrate all of our region's small businesses. All right. And now we are ready for our presentation, but I am going to stop the poll and share the results with you all. All right, so it looks like a majority of you all have either not heard of the employee retention credits, or you have heard of them, or you don't know much about them. And it looks like majority of the businesses have took advantage of the Paycheck Protection Program, the EDIL Advance, the EDIL Loan, as well as the industry specific for the Restaurant Revitalization Fund, and also some folks took advantage of Rebuild Virginia. Awesome. Great. Well, I'm glad to hear that most of the businesses, looks like about just shy of half of us participating today, are back on levels at 2009 or better. That's great to hear. All right. Well, it is my pleasure to introduce Tom Tanner, who is our presenter today. Tom is our lead advisor and vet biz coordinator with the Roanoke Regional Small Business Development Center. And we're so thankful for Tom and his knowledge and expertise. And take it away, Tom.
All right. Good morning, everyone. Again, this is Tom Tanner with the Small Business Center. Excited to see the poll that it looks like about 95% of the people on this class today are not enough familiar with it to even file a claim. So this is, and that 90-some% of you got a PPP. Well, in some ways, this is as good, if not better, than the PPP program, but many people have not taken advantage of it. Anyway, before I start off, I got to throw my disclaimer out there that I've based it on information I've received as of today, and I've made my best information based on information I've received and webinars I've attended, et cetera, et cetera. And of course, the SBA and the IRS can change and modify at any time. So if you plan on applying for this, you want to check to see that with your accountant or your attorney or whoever's helping with you to make sure it's still current and correct. I did reference these IRS notices in this, so if you're interested in learning and doing a deeper dive, these are the IRS notices that you would want to look over. All right, the first thing is I want to just go over some quick facts. Right now, less than 10% of small businesses have taken advantage of this program, and that's 10% of the businesses that actually qualify for it. So there's still a lot of opportunities for people to get money that have not taken advantage of it. And what it comes back to, there was a survey done of accountants, and it looks like almost 50% of accountants haven't filed any ERCs for their clients. And the ones that have, only 25% of them have gone back and filed amended returns for 2020. So we need to be, as business owners, we need to be reaching back out to your accountants, and if they're doing your payroll, are going to be filing this and say, hey, we need to get rolling on this and get this done. A new thing it just launched, and it's going to be launching for the third and fourth quarter, is if you're a small business that just started, you can actually qualify for this program. And that is massive news for new businesses. You can also go back to the second quarter, all the way back to the second quarter of 2020. Just because we're in 2021, if you qualified in 2020, there's no reason you can't go back and get money for this program. The other good news is it has been extended to December 31st. That initially expired June 30th, and now it's extended December 31st. Even though if the infrastructure bill passes, fourth quarter may be gone because they plan on stealing the money out of this program to apply in the bill, but who knows what's going to happen to that bill. So I wouldn't lose sleep over it right now. All right, so first let's just talk about what is the 2020 employee retention credit. So basically it's a credit that if you've experienced one of the following, then you would qualify for it. All I'm going to be talking about today is businesses that have employees or 100 employees or less. There's different stipulations if it's more than 100, but we're not going to talk about that. So was your business fully or partially suspended in 2020 or 2021 in some cases may still be, due to an orders from an appropriate government authority, limiting commerce, travel, group meetings, etc. In other words, was there somebody in government that's either state, local, or federal that said, hey, you guys can't operate, or you can't operate the way you need to, then you would fall under that particular status. Or had more than a 50% decline in gross receipts for any quarter in 2020 versus the same quarter in 2019. So in other words, if in the second quarter of 2020 you did $49,000, and in the second quarter of 2019 you did $100,000, then you fall under that 50%, then you would qualify under this program. Also can be for profits or nonprofits. It is not available for self-employed. And what I mean by self-employed is somebody who files a Schedule C or a partnership return. It does if you have a partnership or Schedule C, if you have W-2 employees, not contract employees, but W-2 employees, then you could apply for this. Owners of S Corps or C Corps are still eligible for this, for your wages, not for any distributions that you may take. And the big news is it's available even if you received a PPP, RRR, EIDL, SFOG, or some of those programs like that. There's several of them out there. All right, for 2021 ERC, basically the same thing that it was for 2020, other than what I have in here in red, which has had more than a 20% decline in receipts for any quarter in 2020 versus the same quarter in 2019. So rather than a 50% decline, all you had to have is a more than a 20%, so 20.00001% decline, then you would qualify for a quarter. Now, I put in here 21 versus 2020 for the simple reason, if you were not open in a comparable quarter in 2019, you could use 2020 as your comparison quarter. Again, everything else is the same. All right, so this is the big news. Is if you're a recovery startup business, and I don't know how many, I should have asked the question up front, were you a startup business or are you an existing business? If you know people who've started up businesses and they have W-2 employees, they need to understand this program and tell them to reach out to us and we'll be glad to help them because this is a big deal. So the requirement is that you must have started operation after 2/15/2020. In operation as defined as the business has begun to function as a going concern and perform activities for which it was organized. In other words, you set up an LLC in 2019, but you never did anything with it until March of 2020, then you would fall under recovery startup business because you really didn't act as a going concern till after 2/15/2020. This is, again, only for the third and fourth quarter of 2021, which we're in the third quarter right now. You had sales of less than $1 million. In other words, if you started in 2020, did you do less than $1 million? And you most likely going to do less than $1 million in 2021. Okay, those are really the only two qualifications. No requirement for decreased sales or anything else. You can still qualify for the ERC if you still, if for some reason you opened in after 2/15/2020 and you still had a 50% decline in 2021 compared to 2020. I mean, a 20% decline in 2021 compared to 2020, you could still qualify under the ERC. Most people would not, but still it's a pretty good deal. It includes 70% of all wages up to $10,000 per quarter. So in other words, you can gain 70% of wages for the third quarter and the fourth quarter. So if you have just one employee that you paid $10,000 in the third quarter and $10,000 in the fourth quarter, then you can recoup 14,000 of that for yourself to come back as a credit. Pretty good deal. The only exception to that for a recovery startup business, there is a maximum of $50,000 per quarter or $100,000 total. It can also apply to a new nonprofit if it was a new nonprofit that also has W-2 wages. All right, just real quick to go over, because we talk a lot about gross receipts and comparing 19 to 20 and 20 to 21, et cetera, et cetera. I just wanted to define what gross receipts are. And really it's the same thing you would see on your federal tax return. Of course, it would not include PPP loans, which it wouldn't be on your tax return. It would not include your EIDL advances, restaurant revitalization funds, shuttered venue operator grants, et cetera. It does include most local and state grants because they were not taken out of the, they were still included as in part of your tax return. And of course, EIDL loans, or really any loans, wouldn't count because they don't really count towards gross receipts anyway. So, and this is just what it is for a nonprofit. There's a lot of slides in here that are most likely not going to cover. They're putting here for more for informational for you. When you get these slide presentations, you can go back over them. Just like aggregation rules, I'm not going to talk about that because it's pretty detailed and probably doesn't involve many people. This is when same owners all own multiple companies. All right, so how was a 50% decline determined for 2020? I talked a little bit about it. It's based on gross revenue for a quarter compared to the same quarter of 2019. And the credit's going to continue until your quarterly revenue has reached 80%. So in other words, if you drop below 50%, you're in that quarter and you'll continue to be qualified for the ERC until you have reached 80% of sales compared to the same quarter in 2019. Once you reach that, then you're no longer qualified for it. And I have some examples that will spell this out and make a little bit more sense to you. So for 2021, basically the same thing, except it's 80% of the same quarter in 2019. If the business was not in operation the comparable quarter of 2019, then you would use the comparable quarter of 2020. I hate to put this in here, but I just wanted to let you know, there's also, to make things even more complicated, they threw this thing in here called alternative quarter, which means You can also select the immediately preceding quarter with a comparable quarter. So if first quarter of 2021, you can go back to the fourth quarter of 2020 and compare it to 2019 rather than comparing the first quarter of 2021 to the first quarter of 2019 or the first quarter of 2020. I'm sure nobody's confused after all that. The credit is going to continue with your quarterly revenue has reached 80%. So in other words, you have to be below 80% to qualify. Once you have gotten back to 80%, you're not going to qualify anymore. You're qualified in that quarter, but you won't qualify for additional quarters. Again, in the examples I'll show you, it'll make a little bit more sense. So what's the amount of credit? Let's talk about 2020 first, because you can still go back and get that. So it's equal to 50% of the qualified wages paid to eligible employees during the covered period. Again, these are W-2 employees, not contract employees, even though there's no such thing as a contract employee, it's a contract independent contractor, but equal to 50% of the wages paid to the eligible employees. And this also includes healthcare insurance paid by the employer and the premiums paid by the employee if they're paying with pre-tax dollars. So the maximum amount of wages you can claim is $10,000. So you can claim $10,000 for all of 2020 or for the quarters that you're qualified for. And you get a maximum of 50% or $5,000 credit per employee for the entire year. And you can cross over to multiple quarters and still be qualified. Again, I'll show you an example that kind of makes this a little bit more simplistic. The nice thing is again, referring back to 2020 and could refer to this year, even the employee is still working, you can claim the credit. In other words, you could have the employee working rather than paying them to stay home, which was part of the process. But even if the person's working, you can still claim the credit. If it's more than 100 employees, they had to not be working and then you were paying. That's why we talk mostly about the ones below 100. The covered period is March 13th to December 31st, so all of last year. All right, so let's talk about the really cool stuff, which is the amount of credit for 2021. So this is equal to 70% of the qualified wages paid to the employees, not 50%, but 70%. So now you're dealing with a 20% drop in 70% of the qualified wages, and it gets better. On top of that, the maximum amount, $10,000 or maximum $7,000, but it's per quarter, not per year. So if you qualified for all 4 quarters in 2021, and you have one employee making $40,000 or more, then you could actually recoup $28,000 for the year. This is not chopped liver, man. This is a pretty good deal. Again, we talked about if employees are still working, and we talked about healthcare coverage. And again, this coverage is from January 1st, 2021 to December 31st, 2021. Okay. All right. So I put together a little chart that hopes to explain this information a little bit better. So it's just like you can just look right at it. So I broke it down into 3 different sections. One is the round 1, which was last year, round 2, which was January to June 30th, and then round 3, which is the 3rd and 4th quarter of this year. So we talked about, can you use with PPP, IDL? Yes, but it can't be the same wages. And I'll show you an example of that a little bit later on too. Shows you the eligible wage base, $10,000 is going to be the same. The credit amount is 50% for last year and 70% for both this year. Maximum amount of credit is $5,000 per employee or $7,000 per employee for this year per quarter. And we talked about the recovery startup business. Again, this is any business that started after 2/15, you would qualify. This is $7,000 per employee per quarter with a maximum $50,000 per quarter or $100,000 total. All right, so let's do some examples here. So we're going to talk about the 2020 first. So we're going to look at quarter 1, 2, 3, and 4 of 2020. So in 2020, this particular company had gross receipts of $28,000 compared to 2019 of $30,000. So they were at 93%. So it's not an eligible quarter, which most likely wouldn't be because it didn't start till the middle of March anyway. So most likely nobody's going to qualify for this first quarter. All right, for the second quarter, their gross receipts was only 18,000, but the gross receipts from 2019 was 40,000. So they dropped significantly and they had 45% of sales in 20 versus 19. So they do qualify for this particular quarter for the ERC. All right, so 2020, they started inching their way back up. They got to $40,000 when in 2019, their gross receipts was $50,000. So now they're at 80%. So at 80% is the month that, hey, they've reached back, which means they're not going to qualify anymore. The difference is they're still reaching back in that quarter, so they still qualify for the current quarter, but will not qualify going forward. So we just look at quarter 4 where they're back at 100%. So they don't qualify because they dequalified after the third quarter. And the only way they could requalify if they had dropped back down to below 50%. All right. Hopefully that's pretty straightforward. Let's talk about 2021, which is a summer thing. So in first quarter, they were at 75%, which means they dropped below the 80%. So it's an eligible quarter. In quarter 2, they went above the 80%. So they're basically going to get kicked out after this quarter, but they're still qualified for this quarter. In the third quarter, they didn't go back down below 80 cents, so they're not going to be qualified for the third quarter. Pretty cool so far. All right. So now let's get into the nitty-gritty of looking at individual wages. So let's take the first example. We got 3 employees here. So employee number 1 in quarter 2 was paid $15,000. So the program in 2020 was $10,000 per employee. So he used up that entire $10,000 in the first quarter. So in third quarter, he had $15,000, but there's nothing left. So he's not going to qualify for any wages. In the fourth quarter, he's not going to qualify for any wages. Okay, in quarter number 2, employee number 2 in quarter 2, he had $6,000. So he had $6,000 worth of qualified wages. He still got $4,000 left over. So in quarter 3, he had $8,000. So he could still use $4,000 for that employee to reach his $10,000. In quarter 4, there's nothing left, so he's not going to get anything. And then employee 3, you'll see that he didn't max out his $10,000, so he was able to use the entire amount. So at the bottom, I did some basic math, added everything up, which was $29,000, took 50% of that, so you would be getting a credit for $14,500. Sounds pretty good. All right. So let's look at 2021, which is really the smoking deal. So let's take, again, the same employees, 1, 2, and 3. So in the first quarter, this first employee made $15,000. So he got $10,000 of qualified wages. Okay, it now resets back down to 0 in quarter 2. So he had $15,000 again, so he qualified for $10,000 in wages. In quarter 3, he had $8,000, so he'll qualify for all $8,000. And in quarter 4, he had $12,000, but he can only qualify for $10,000 because it resets to 0 at the end of each quarter. So in employee 2, you can just go across and see how much is generated for each person. So as long as it hasn't reached 10,000, they can claim all their wages. So if you add all that up, if you add all their wages up, it was $80,000 in wages for all 4 quarters. If you take 70% of that, that's going to give you a credit of $56,000 for this program. All right, some other issues with that. they did allow you to start, if you take it a PPP or any of these others. Initially, they said, well, if you received any of those, you can't take the ERC. So they changed that so that you can take it. You just can't use the same money for it. And I'll show you in a second what I mean about that. Also, if you claim an ERC, the payroll is not deductible. I'm sure you realize that, you know, under the PPP, one of the cool things about it was you didn't have to count the income, but you also were able to take the deduction, something that's pretty unheard of, but they allowed you to do that. Well, that doesn't work for the ERC. You get a credit, then you can't take the payroll that was used to receive that credit. They also decided, since this thing is going to be a massive undertaking for the IRS, that they said, well, we needed 2 extra years that we can go back and audit 941s rather than typically 3 years they can go back and audit. So we want to be to go back and audit 5 years. So once everything gets done and caught up, we want to go back and check everybody and see what's going on. So you need to make sure that you're keeping all your payroll records and justification for this credit for 5 years. The last thing I'm not going to talk about much, but there is a section in there called severely financially distressed employers. And that's somebody who had 90% or more. If your business falls under that territory, or if you know somebody that does, there are some special considerations for that business too. Whoops, I missed it. All right, so this is a chart I did up to kind of show the PPP versus the employee retention credit. So under this, my assumption is that there was a PPP loan of $50,000. And under the first assumption, we're going to say we used it all as payroll, which a lot of people did because it was just simpler to say, okay, we're just going to use it all as payroll to get it done. Okay, so we're going to use that as initial assumption. So in January of 2021, this particular company had payroll of $20,000. So they applied their $20,000 PPP loan to it. Under this scenario, there's no ERC wages available that you could claim, okay, because you've already used federal money to pay for it. So now we go to February, we had $25,000 in payroll. Well, you still got some money in your PPP, so you're using that. So there's still no ERC wages available in February. So then you used to go to March and you had $30,000 in payroll. Well, you've only got $5,000 left of your PPP, which allows you to also claim $25,000 as ERC wages. So you could claim a credit of $17,500 for that $25,000. You couldn't claim it for all it, but you could for that particular $25,000. Okay, this is a very simple approach. There's a lot you can do with it because you know you can spread PPP over 24 weeks, so you can manipulate the images. I mean, manipulate the numbers a little bit to come up with ways that you can claim part of an EAC in certain quarters in case you were qualified in one quarter and not a quarter. So there's things you can do to kind of play with these numbers to make them work. I'm just trying to show you a simple approach. Another approach I'm throwing out here just to show you is, you know, under a PPP, you could use as little as 60% for payroll. So let's take this same PPP loan of $50,000 and you're going to use 60% for payroll, which means you really only have to use $30,000 of that for payroll. So let's take the same assumption. In January, you had $20,000 in payroll, and your PPP wages, you're going to go ahead and use $20,000. Okay, so you don't have any ERC wages available for that. In February, you have $25,000 in payroll. Well, you've only got $10,000 worth of PPP money left out of that $30,000. So that's going to allow you $15,000 of ERC wages. And then you go to March, you had $30,000 worth of payroll. So that's going to allow you to use the entire $30,000 of ERC, or a total of $45,000, or a credit of $31,500. So it's just a matter of, it's the same $50,000. It's a matter of how you classify it when you turn in your forgiveness for PPP. Of course, if you already turned in your forgiveness for PPP, it's too late. But if you haven't, then you may be able to, you and your accountant or whatever, be able to play with these numbers a little bit to make them work to your advantage if you're claiming the credit. All right, just some FAQs I took off the IRS website just to kind of go over a few things. Are employees required to withhold employment taxes? Yes, that doesn't change any. And we already talked about self-employed. If a business decides to close, reduce hours of operation, even though it was not required to, you cannot claim the credit. In other words, just because you decided you didn't want to open, it doesn't allow you to claim the credit unless you fall under the 50% or the 80% rule. If for some reason it just got really bad, you decided to close down and you fell under the 50% or 80% rule, then you could qualify for it. If you're shut down because of supply chain, there's cases that you might be able to make that you could qualify. Of course, it's only going to be for the period that you're partially shut down because of supply chain. And you're going to have to somehow justify it if you're ever audited for it. So just make sure before you claim something like that, you feel pretty comfortable that you can justify it. If you're required to shut down or partially shut down, but then you open back up, you can only claim the credit for the during the period of shutdown and partial shutdown. Again, that's if you're required to shut down and you don't reach the 50% or the 80%. If you reach the 50% or 80%, then you just ignore this because then you're being covered by the quarter that you dropped into it, and you're also covered by the quarter that you got back into the 80% level. We always talk about gross receipts. We talked about that. If you purchase a business, you can take the information from the business you acquired, regardless of whether it's a stock purchase or an asset purchase. Tax receipts for gross exempt, we already talked about that. So this is one that could be a big deal for some businesses. If you are paying wages to a related individual, and you can see what they were talking about, a related child, grandchild, and you know, every person pretty much besides your spouse, then they're not considered qualified wages, even though there are some circumstances. This gets a little confusing because the IRS really confused it by a notice that came out that said, well, under certain circumstances, this happens, under other circumstances, this happens, et cetera, et cetera. But sitting in and talking to other accountants and attorneys and sitting on some programs, most of them have kind of come to consensus is if it's an owner or spouse of an owner, you can include all the qualified wages. If it's a relative of an owner that owns less than 50%, you can include those wages. If it's an owner of more than 50%, you cannot include the wages of relatives. All right, so now the big question is, how do I claim this sucker? So if you have, if you're claiming for a paid period in 2020, what you have to do, since we hope you've already filed your 941s, if you haven't, then you can file your 941s, but then you'll probably get a penalty for it. But anyway, if you've already filed your 941s, you have to file what we call a 941X, which is an adjustment or amended return. Okay. If you're claiming for 2021 for a quarter that's not filed, then all you would do is take the claim on your 941. If the 941 has already been filed, such as like first quarter and second quarter of 2021, which it probably has, then you would be required to file a 941X, which again, you would have to amend your original return. But for the amount of money we're talking about, it's worth a little administrative hassle. There's also a form, it's called advanced payment employee credits. This has not been received very well, taken very long periods of time. And since we're in the third and fourth quarter, it's probably really not going to be useful for many people. I was just throwing it out there to let you know about it. All right, so I'm not going to cover these forms in detail because you probably don't want to listen to me cover in detail, but I just want to throw them in here for your reference. But there's a couple of things I do want to point out. One is, if you electronically file a 941, then you typically can expect a refund in 5 to 6 weeks. It just depends on what's going on at the time. If you manually file a 941, which I highly not recommend doing, you can expect a refund sometime in the future. So the last thing I read from the IRS, and I get daily updates on things, is they have over 2 million 941, manual 941 sitting around that they're going through. So it's going to take a while for them to go through this process. If you're submitting 941Xs, you have no choice because they have to be submitted by paper. All right, so the way this credit works, there's a non-refundable portion and then there's a refundable portion. And for first quarter and second quarter, I'm not even gonna talk about since that's over with, but basically you would apply the non-refundable to any money that you as an employer has put into it through Social Security. For the third and fourth quarter, basically what you can do is withhold payments to the IRS and your 941 payments equal to the amount of the employer Medicare payments to apply towards the credit that you think you're going to, or the amount of money that you think that you want to apply for. Again, it's only 1.45%, so it's not going to be a large number anyway. So most of the money that you're going to get is going to be refundable, which means you've got to submit this, they have to go through it, and then they send you a check sometime in the future. Again, this just shows you the refundable credit, and that's just going to be the total credit minus the non-refundable portion. And it also talks about qualified wages and the total cost of the healthcare plan expenses. And if you really want to get deep into this thing, these are the worksheets that you use to figure all this out. And I will tell you, if you're electronically filing it, whoever you're electronically filing with should be able to enter this data and it'll figure all these worksheets out for you. But I stuck them in there in case you really want to get deep down at how this program works. But I'm not going to cover it. All right, so this is the 941X, which again is the adjustment or the amended return. I put in here 8 weeks because that's what they say, but everybody I've talked to has pretty much said that nothing's coming back in 8 weeks. So, but that's okay. If you apply for it and it's 6 months from now, it's just a, you know, it's a big summer bonus next year or whatever. So the way that works, you basically would just put in the corrected amount of what it should be. You would take in, subtract what you originally put in and what the difference is, and then the tax correction. And then basically on the last page, give an explanation. You know, I'm not going to go in detail on how this works, but I just want to show it to you. So, and this is the advanced credit. Again, I'm not going to show you how to do it. I just want to let you know that this is available. So that is really the presentation. I don't, Heather, you might want to stop the recording and then we can go into question and answers because there's probably at least one question.